Hey everyone, and welcome to this explainer where we're going to demystify the stock market right from the ground up. If you've ever tuned into the daily financial news, it can totally feel like this crazy whirlwind, just flashing red and green numbers, people shouting over each other, and just endless hype. Well, today we're stripping all of that away. We are focusing purely on first principles. How does this massive system actually work? Why does it even exist? And what is really happening behind all those glowing screens?
So let's just dive right into it by starting with the absolute most fundamental question, one that honestly gets completely lost in all that daily noise. When you log into an account and you click buy, what are you actually purchasing? It's really not just a digital ticker symbol or some random blip on a screen.
Here's our roadmap for today to build up that understanding. We're going to cover owning a piece of a business, moving from private to public, the stock exchange marketplace, stocks versus bonds, why stock prices move, and finally, understanding the risks. So we're really scaling all the way from the most basic unit of ownership right up to global price movements.
All right, part one, owning a piece of a business.
The absolute most crucial thing to wrap your head around is that a stock is a real, tangible piece of a company. When you buy a share, you become a shareholder. You are a true, literal part owner of that business. You're acquiring a residual claim to a fraction of the company's assets and the profits it generates. You aren't just placing a bet on a number going up, you're participating directly in the actual economic engine of that specific corporation.
Let's look at a concrete example, like IBM. Owning their stock means you essentially own a microscopic fraction of their physical plants, their massive computer servers, their equipment, honestly, technically, even a tiny fraction of the break room coffee machine. But far more importantly, you own a claim to the cash flow that those assets generate. That equity gives you a literal seat at the table. It comes with voting rights on certain company decisions and, potentially, a share of the profits paid out to you as dividends.
Moving on to part two, from private to public.
So, now we know what a share is, but how do they get created? The journey to the stock market usually kicks off when a private company decides, hey, we need to raise a significant amount of capital. To pull this off, they conduct what's called an initial public offering, or IPO. This is the exact moment a private company crosses over to the public market, offering up its shares to institutional and everyday individual investors for the very first time.
And companies don't just sell off parts of themselves just for the fun of it. They issue shares to raise essential capital for actual real-world needs. Maybe they want to build a massive new factory to expand, or maybe they need to fund some cutting-edge research and development. Sometimes it's to pay down expensive debt, or just to scale up their daily operations. By selling shares, they get that crucial cash without having to take out a massive, interest-heavy loan from a bank.
Which brings us to part three, the stock exchange marketplace.
Once those shares are created and sold through an IPO, people need a dedicated place where buyers and sellers can easily find each other to trade. Enter the stock exchanges. Think of these as the massive, organized marketplaces acting as the vital plumbing for the entire global financial system. Exchanges like the New York Stock Exchange, which, fun fact, originally started with traders just signing an agreement under a buttonwood tree back in 1792, along with the NASDAQ, the London Stock Exchange, and the Tokyo Stock Exchange. These places provide the secure infrastructure that connects a buyer in one place with a seller in another.
Let's look a bit closer at the world's most famous example. The New York Stock Exchange uses a really fascinating hybrid system. It combines lightning-fast modern electronic trading with traditional human-driven market mechanisms. And this setup exists for a very specific reason, to support fair price discovery and keep the markets orderly. It basically ensures that when you decide you want to buy your tiny piece of IBM, there is a transparent, reliable system perfectly matching your order with someone else who is willing to sell.
Okay, part four, stocks versus bonds.
To truly grasp what a stock is, it's super helpful to contrast it with the other major financial asset you always hear about, the bond. The difference here is night and day. Like we've established, buying a stock makes you an owner. You share in the growth, you might get dividends, and you get a vote. But if the company struggles, well, you take the hit. So it's a higher risk, higher potential reward situation. A bond, on the other hand, is quite literally just a loan. You are the lender and the company or government is the borrower. You get regular fixed interest payments and your original money back at the end, but you don't own the company and you get zero say in how it's run. Because it's generally lower risk, it offers a lower potential reward.
All right, part five, why stock prices move.
So we know what stocks are and where they trade, but what is the deal with those constantly changing numbers on the financial charts? At its absolute core, if you strip away all the complex algorithms and the fancy financial jargon, every single price movement is just a simple tug of war between supply and demand. If demand from buyers outpaces the supply of shares from sellers, the buyers literally have to bid the price up to get the shares they want. Conversely, if sellers are desperate to offload their shares and buyers are nowhere to be found, well, the sellers have to drop their asking price. That is it. That is the fundamental reason why prices move.
But you might be wondering, what causes that tug of war? What makes the buyers or the sellers suddenly so aggressive? Well, it's a giant, complex mix of real-world factors. Some investors focus purely on the company's actual earnings and profit margins. Others react to broader economic conditions, things like inflation and interest rates. Some folks just look at the momentum of a chart, while everyday investors might just react to breaking news or new industry trends. Ultimately, it all boils down to one thing: investor expectations and their sentiment about the future.
And finally, Part 6, Understanding the Risks.
Is the stock price the exact same thing as the company itself? It is incredibly vital to pause right here and ask this, because confusing the two is probably the most common mistake beginners make. It is so easy to look at a plummeting stock chart and instantly assume the underlying business is completely falling apart.
But the reality is a lot more nuanced than that. Over the long haul, yes, a company's stock price is deeply connected to its actual business performance, its ability to innovate, grow, and actually make money. But in the short term, stock prices can fluctuate wildly due to fear, greed, overall market sentiment, or global news events that have absolutely nothing to do with how the company operates day to day. And this right here is where the risk lies. Investing means accepting that prices can drop entirely independently of business fundamentals. And yes, because of that, investors can and do lose real money.
We have covered a lot of ground today, all the way from the basic concept of partial ownership to the actual mechanics of supply and demand. Understanding that the market is, at its core, just a system for capital formation, completely devoid of all that daily hype, gives you a much clearer lens to view the world of finance. So, the next time you see some frantic headline about a massive stock market surge or a sudden crash, ask yourself, are you actually looking at a fundamental change in a real-world business, or are you just watching a temporary shift in the tug-of-war between a crowd of buyers and sellers? Keep learning, keep questioning, and I will catch you in the next explainer.